Good morning from our global headquarters in New York. I'm Menace Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Charging ahead, Evercore, Citi and Goldman all boost their bullish calls for U.S. stocks. Disruption paused. French yields steady after political uncertainties drive 10-year spreads to their worst week since the 1990s. And the housing slump in China deepens, triggering new calls for Beijing to pump in more cash. A very good morning. We kick off the week with this trifecta of bullish calls from Evercore, from Citi and from Goldman Sachs. Late on Friday, Evercore goes for 6,000. Again, the AI revolution is the propulsion. We give back to flat at the moment. You did put on 1.6% on the S&P 500 last week. And tech, it was a furious rally in tech, over 6.4%. And that momentum, Ed Yordeni asks whether we're in a momentum melt-up or a blow-off top. I'll leave it for you to consider. Citi say go overweight the U.S. relative to Europe. Goldman's boost their target to 5,600, and Evercore lash it out at 6,000. The CAC, however, had a torrid week last week. The tail that wagged the global risk dog and really cemented U.S. hegemony is what the market is saying, is that tail risk in France of Le Pen exceeding to fiscal control in France really gave the CAC a pacing down 210 billion euros. So the French political risk, along with a disinflation narrative, added to a drop in the yields, down by 21 basis points. You've got a $13 billion 20-year paper later in the week. And Kashkari intimates that the Fed will be one and done. The China data is pretty torturous this morning in terms of housing. We'll break that down for you in a moment. I thought we'd reflect that with copper. The depth of the housing crisis is still there. You're at an 8-week low on London copper, down for 4 weeks in a row. So that's just a manifestation of that particular commodity. So we talked about Europe and the risk. Let's get that in first of all, because we have turmoil in France looming over the EU summit in Brussels. The French president, Emmanuel Macron, calls that snap election fueling concerns of further advances for the far right. For more, let's bring in Caroline Conan. She's standing by. Caroline, the imagery from the weekend was pretty potent. This was France demonstrating against Le Pen, but Le Pen, of course, reinforces one soothing line to the markets in terms of what cohabitation could look like. Describe the weekend for our viewers.
Manis, what's very interesting is the number of people in the streets over the weekend protesting against Marine Le Pen and against the far right. There were 250,000 across the country, according to the French police. Now, let me throw back to 2002. That was when Jean-Marie Le Pen was facing Jacques Chirac in the second round of the presidential elections. At the time, you had 1.3 million French people in the streets protesting against Jean-Marie Le Pen. So that's 5 times more people than what we saw in France over the weekend. That shows you how things have changed over the past 20 years, how Marine Le Pen has done a very good job at trying to detoxify her party, at trying to make it look more normal, more reasonable. In an interview with Le Figaro over the weekend, she actually said that she was ready to work with President Macron, that even if they do get a majority in the National Assembly on July 7, that doesn't mean any institutional chaos. Clearly, she is trying to appeal to the more moderate right-wing part of the electorate.
Yeah, and it's interesting where she comes out and she says, I'm respectful of institutions and I'm not calling for institutional chaos. And the markets really don't understand our fiscal policy, of course, intimating that it's Macron who has invoked the chaos by pulling the ripcord on the election. So let's talk about those polls. How do they translate? Because there could be a coalition on the left with an accession of the right, leaving an eviscerated power in the middle for Macron.
There is actually a coalition on the left already, and the problem with that coalition on the left is that it includes the far left. So, of course, the far left has this very charismatic leader of Jean-Luc Mélenchon, but it's also a turnoff for a big part of the more moderate left-wing electorate. So the polls, what are they saying at the moment? They're saying the national rally of Le Pen would get between 33 and 35% in the first round. Macron's party would get between 18 and 20%. And in between, you have this coalition of the left left, that would get between 25 and 26% in the first round on June 30. Now, of course, this is a two-round system, so depending on who gets first in the first round, we'll have to face whoever is left in the second round. That means a lot of Macron's candidates may actually be even excluded from a second round in those elections. In any case, that would mean that the coalition of the left would be the only alternative forces currently, if we're looking at the polls, for Emmanuel Macron to work with, to choose a prime minister who doesn't belong to the far right.
OK, well, let's see how this plays out, Caroline. A long way to run and many more polls to come. Caroline Conin with the very latest on the French political situation. To China, I mentioned the price of copper this morning dropping. We've got this property slowdown showing no signs of letting up. The latest data disappointing, to say the least, leading to calls to pump more cash into the economy. This comes as the PBOC kept rates unchanged for its 10th straight month. Rebecca Chung-Wilkins is with me with the key takeaways from the May economic data. Rebecca, good to see you. I mean, anywhere you look at this housing data, it's pretty brutal, but maybe we were just too optimistic that the surpluses in the housing market would clear quickly. Contextualize the disappointing data.
Yes, absolutely. And the property market, as you say, very much in focus in the May data. Now, we saw prices, home prices falling at a faster pace in May, new home prices coming down 0.71% and existing home prices coming down 1%. It's that existing home prices that it's really sort of hurting. But the broader context, as you say, is that because we saw this really forceful push from Beijing to try and salvage the property market, try and put a bottom under the property market with this $350 billion US plan to mop up some of the unsold housing. This part of this affordable housing scheme where local SOEs and local governments would start buying some of these properties. There was hope that we would see some kind of improvement translate into the data for May. Now, that hasn't happened, clearly, and there was some expectation around this. I mean, analysts have warned, for example, that the trials that we've seen so far have been too small in scale, that it takes a really long time for this type of policy to transmit into the rest of the market, but certainly disappointing. And just into broader context, again, we see this sort of reiteration, this underscoring of the uneven growth model here, with exports, clean tech industries sort of supporting GDP. There was this bright spot with retail numbers. They came in a little bit better than expected, but overall the levels are still quite a ways below pre-COVID.
And then, of course, we have the PBOC leaving rates unchanged. And then you look at the credit impulse. I know the credit impulse actually got a little bit of a boost in terms of some of the bond issuance. But again, the PBOC holding firm. And this is more about perhaps a position, a reflection on their currency perspective rather than macroeconomics.
Yes, I think that's absolutely right. It's sort of, just to put it simply, they just don't have much room to lower it because they do not want to start pressuring the currency. They don't want to pressure the UN. Partly, of course, they have one eye, of course, on the Federal Reserve that promised to keep things sort of safer for longer. That's another concern for them too. So there isn't an enormous amount of room. The thing to really start watching for, I think, is probably the mid-year Politburo. We might see a bit more news emerging from that meeting around just where we go now with policy rates and also fiscal policy. And then, of course, the big meeting is going to be the third plenum. We don't have dates for that, but that is coming up in July. And it's the sort of one key meeting where I expect to see perhaps some hints that she might be taking much more forceful steps to try and support the economy.
OK, Rebecca, thank you so much for being with us. Rebecca Chung-Wilkins. And this morning, as of course, China starts an anti-dumping probe into EU pork imports. So anybody thinks that the tariff landscape between the US and China is the only point of disruption, very much mistaken, as again, another anti-dumping probe into pork imports from the EU. So we have maximum uncertainty gripping markets, certainly in Europe over the past 6 trading days. Stephanie Roth is the Chief Economist at Wolfe Research. She joins me now. Stephanie, good to see you. Who would have thought that, you know, the tail risk of the world would be the French government elections? But it does show you this potential risk of a whole new complexion of politics in France has made us waken up, I think, really to the political risk that could manifest later here, much more prevalently later in the year here in the United States and more America. What did you make of the disruption, so to say?
Yeah, I mean, I think it's just a reminder that now we're starting to hit the election season, and now we have to start thinking about tariffs in the U.S. and what Trump might mean for the U.S. economy from a tariff perspective, because that's starting to come into focus. People weren't really talking about that earlier this year, and now all of a sudden it's like, well, actually, this may actually be a reality, and we're talking about potential 60% tariffs on China and a 10% across-the-board tariff, which could hurt U.S. GDP by well over a percentage point. So I think this is just starting to become a reminder that we're shifting into this political landscape territory, and elections in France are just sort of a catalyst into this. And this is summertime is really when this is going to start to become in focus.
Do you think that possibly the spook that we had last week was even more adjusted, let's say, more aggressive because of perhaps a lack of liquidity and maybe the beginning of that summer season?
I think that's fair. I mean, every summer, especially in August, you
I think everybody's gone already.
Exactly. Every summer you often see something blow up in markets, and it's partially because of liquidity.
Okay, stay with me. We've got a little bit more to do. We're going to talk about what the Fed's perspective is. Is it one and done, according to Kashkari? I'm going to get you up to speed with your other stories on the Bloomberg terminal this Monday morning. What have we got for you? Buying TSMC shares in Taiwan while shorting its U.S. listing has been long a popular trade. It started to backfire, however, as the enthusiasm over AI in the U.S. pushes the Western listing to its most expensive versus the stock in Taipei. Regional finance hubs, Hong Kong and Singapore, have topped a new global list of the world's most expensive cities for expatriates, keeping Swiss destinations from the top spots for the second year in a row. Bill Gates says he is now prepared to deploy billions of dollars into the next generation nuclear power plant project in Wyoming to meet the growing U.S. electricity needs. Coming up in the show, Wall Street's boosting their calls for U.S. stocks. More on that with the Truist Chief Market Strategist, Keith Lerner, a little bit later this hour. Stay with us. Good morning from New York. This is Bloomberg.
We're in a very good position right now to take our time, get more inflation data, get more data on the economy, on the labor market before we have to make any decisions. So we're in a strong position. But if you just said there's going to be one cut, which is what the median indicated, that would likely be toward the end of the year.
From 6 all the way down to 1 in the span of 4 months. The expectations for the Fed's rate path has seen some changes this year. Stephanie Roth is with Wolfe Research and remains on the desk with me this morning. So here we go. I mean, essentially what Kashkari is saying, we're one and done if you're lucky. And that is not what the markets, I mean, the markets are really front running the presumption this disinflation narrative will accelerate, isn't it?
I think that's fair. I mean, Q1 inflation, if you look at the average inflation in Q1, it was 4.2%.
Right.
In Q4, it was 1.5%. Was inflation either of those things? No. Inflation's probably running closer to 2.5%, which is okay for the Fed to be cutting.
Do you think they're overly cautious then? I mean, one after another ask for patience, they ask for prudence, they ask for time, they're data dependent. Are they being overly cautious?
You know, perhaps. I think Powell is appeared for a period of time to be one of the most dovish members of the Fed. For a period of time a couple months ago, he was one of the ones saying, yeah, we're sticking with this inflation seasonality thing, when the rest of the FOMC members seemed to be throwing in the towel on that. But what we've learned over the past week or so is perhaps that's really true. And we're going to see core PCE print something like 0.17 for the next couple months, and then the Fed can cut in September.
Where does that disinflation come from? Where does that momentum, the continued momentum in disinflation, as you say, 0.15, it's tracking the core PCE is tracking 0.15% down for May. If we continue to get readings like this through the summer, they will cut. So where's the most disinflation going to come from?
Two things. One is going to be rent inflation. We've been talking about this for the longest time, and everybody's sick and tired of it.
I hope you can see it before I see it. Go on.
So there's seasonality problems in the rent inflation data, right? So in June, it completely goes the other way, in which case you actually could see that step down in OER everybody's been looking for many, many months now. But it's the next print that actually might be the place. And we were saying this in a couple months ago, too. It's not as if we're just looking for the next print over and over again, but it actually is the June print where this goes the other way.
There is the growing argument that you're going to see the rise rise of the dual mandate. In other words, you're going to need to see a significant rise in unemployment, somewhere to the 4.3, the 4.4%, before they're going to take the action. Where do you stand on that?
You know, first of all, the employment rate did rise to 4%. Granted, now they're talking about perhaps distrusting that data a little bit because it's been so distant from where the actual payrolls growth has been. So if you look
say
at
it's temporary. You say the recent softness in growth in this cycle is temporary, and we're going back above trend GDP. Atlanta GDP is tracking 3.5% at the moment. So it's going to be, I can't see how we get to 4.5% unemployment.
And maybe we don't need it because we have so much labor supply right now. Immigration trends have been really strong, which is the reason why the labor market has been able to rebalance in this environment. So I'm not sure they're looking for 4.5% anymore. I mean, the dots told you that. They're looking for a number a little bit above 4%, and they can still cut this year. So they're not necessarily relying on that, but I do think we probably need to see a softening. 250 on average in payrolls is probably a little bit strong for them to be able to actually be cutting. So if you see something like 200,000 or below, then that's a better environment. They want to get a couple cuts under their belt.
They want to get a couple of cuts under their belt, I think, but it's going to be potentially a fundamentally different scale of cutting cycle than we've seen historically. That's what the consensus seems to be. It could be one and done, according to Kashkari, and that's going to be at the latter part of the year. Or at the most, it's going to be two. You're talking about potentially 50 basis points. You're not talking about anything shocking or radical that's going to change the mortgage market.
No, that's fair. We're talking about 2 cuts this year. Next year, we should probably get another couple of cuts. The thing that complicates things is if we end up with this big tariff situation. But we don't think that will actually go into effect until 2026, in which case they could probably get another couple of cuts done next year, too.
The speed of the bond market repricing last week was interesting, wasn't it? After the CPI and then the Fed reducing their dots, but still the bond market rallied, down 21 basis points. I've got in my inbox this morning furious bullish equity market notes and actually quite bullish bond notes, sub 4%. And I think these disruptive moments like French politics add to that momentum in the bond market, don't they?
Yeah, I think that's totally fair. And it was driven by the data and not the Fed last week, right? I mean, the Fed surprised us, if anything, slightly hawkishly. But it was the data that came out the morning of the FOMC that really moved markets, and for good reason.
Okay, let's leave it there. We'll see where we go to. The question is, let me just ask you this. On consumer confidence at a 7-month low. I mean, in the background of all of the hard data, there is another soft indicator that sort of suggests there's a little bit of a fissure in the system as well, doesn't there?
Maybe, but if you look at consumer confidence...
You're skeptical on that?
A little bit. If you look at the past 18 months, consumer confidence would tell you we are in a recession, and that hasn't been the case at all. So it hasn't been a great...
Do you think it's a bifurcated consumer? In other words, the consumer sentiment may well be lower at the lower end of the market, and it's resilient at the upper end of the market?
I think it's a little bit of both. I think it's a combination of the lower-end consumers is actually getting squeezed, and also people aren't happy that prices are high, but they can afford to pay it. So they're not thrilled about it. They're not thrilled about the political situation, but they're actually able to afford to spend, and they have been. Okay, well, let's see what those retail sales give us this week. And we've got another little taster of an auction to come. Stephanie, thank you so much for being our guest this morning. That is Stephanie Roth of Wolfe Research. Coming up in the show, a look at some of the other headlines making news this Monday morning. Context matters on Bloomberg. It's Bloomberg Brief this Monday morning. I'm Manus Granny in New York. Time for a quick look at the front pages and what's making the headlines around the world. First up, we go to the Washington Post. President Biden, former President Barack Obama, along with a host of A-list celebrities, warning of the dangers of a second Trump term. This was at a fundraiser over the weekend. The Biden campaign called it the largest ever Democratic fundraiser. They said to raise more than $25 million. And they're getting ready for a big TV spend going into this debate. Next up, on Bloomberg, Northeast will be experiencing its first heat wave of the season. Manhattan is set to reach 91 degrees Fahrenheit on Tuesday and steadily get hotter through the week, with humidity making it feel closer to 100 degrees. Wow, get your aircon on. It's set to raise electricity demand, slow the transportation networks, and it is threatening a number of health risks.
And on the Journal, Pixar's Inside Out 2 generated an estimated $155 million in the U.S. sales in the opening weekend. Now, the strongest debut for a film this year and a jolt for the summer box office. Its domestic gross far exceeded that of the $90 million the box office trackers had expected. Now, we've been talking about the protests in France against Marine Le Pen over the weekend. Manifestation of perhaps just a taming of risk. You saw the CAC last week lose over 210 billion euros worth in value. So you've seen a small steadying in the French assets this morning. Let's have a look at that for you. These are the US cross assets for you. Let's have a quick look at the European assets in the first instance. There you go. You got the CAC adding an 1%, as I say. You've had 4 weeks of outflows from Europe, and the far-right leader Marine Le Pen saying, look, she's respectful of institutions, again, trying to soothe some of the frayed nerves in the bond market. Yields trade at 3.19. Bear in mind, by the way, France is rated AA, Italy's at BBB and 390. It's been a long time since we talked about French government bonds, but we are far from a debt crisis. Of course, the concerns are around the fiscal policy of the national rally, and the euro-dollar steadies. Let's see what happens this week, as Kashkari says we will probably be one and done before the end of the year on rates. This is Bloomberg. From our global headquarters in New York, I'm Menace Cranny. Let's set your agenda. Charging ahead, Evercore, Citi and Goldman all boost their bullish calls on U.S. stocks. Disruption paused, French yields steady after political uncertainties drive the 10-year spread to Germany to the worst week since the 1990s. And a housing slump in China deepens, triggering new calls for Beijing to pump cash and credit into the system. A very good morning to you. This is at the state of affairs. We've got a trifecta of calls hitting the tape this morning. Equities are a little bit flat this morning. The S&P 500 rallied by 1.6% last week. Tech was pretty virulent, up over 6%. Again, a real reaffirmation as political chassis in France delivered American asset hegemony. The question Ed Yardeni asks is whether we're in a momentum melt-up, a blow-off top. To the bond market, you're looking at 423. We dropped by 21 basis points last week, the biggest weekly drop since the middle of December. The disinflation narrative grows. Neil Kashkari over the weekend talks about the Fed potentially being one and done by the end of the year. Certainly the market is just got cloth ears to the guidance, the verbal guidance from the Fed, and much more focused on the disinflation narrative. Copper, there is the dollar for you. It's flat at the moment. 12.6770 is where we are on the dollar. Again, the bullish sentiment around the dollar remains. So let's talk about those Wall Street bulls. They are getting more bullish. Evercore, Citi are just the latest teams to boost their calls on U.S. stocks. Julian Emmanuel sees the macro and the monetary conditions supporting Goldilocks with a year-end S&P 500 target of 6,000. Morgan Stanley's Mike Wilson strikes a more cautious tone, writing this. With economic surprise indices and bond yields falling, many stocks are now becoming more sensitive to softer growth conditions. This is the classic late cycle phenomena. Keith Lerner is a Co-CIO, Chief Market Strategist at Truist. You've seen a cycle or two. I mean, there's a frenetic frenzy to these new targets. 6,000 from Julian Emmanuel, evangelizing the AI situation. Goldman's upping their call by 3%. Do you think we're in a frenzy or just a pragmatic reassessment of the halcyon USA days? Good morning.
Hey, very good morning to you, Manus. Listen, I think what's happening is this market, especially at the top end, is moving quicker than strategists can adjust. So that's what you're seeing. We actually upgraded equities on April 23rd. And we've moved up about 8%. So as we're moving higher, we're still constructive over the immediate term, but we're not becoming even more bullish as prices move up. I think this market, as you look at the last month, the S&P technology sector is outperforming the S&P by double digits. It's the most in 20 years. So, you know, listen, it's hard to say when that momentum ends. We still like tech longer term, but I think we're more likely to be in somewhat of a more choppy fashion as opposed to the start of something new. I mean, again, Earning trends are positive. The economy's in a good shape. We will be on an easing cycle globally. But again, we're not getting more bullish as prices go up as some of our peers are.
I mean, the whole belief that we're going to enter some magnificent easing cycle is getting more challenged by the day, Keith.
Yeah, but I think the most important thing is the direction. It's not so many other, we're going to have 3 or 4. Is the next move more likely a global easing cycle? And I think that's correct. I think as long as even with the Fed, I mean, I know there's a big debate now. Is it 1? Is it 2? Is it none? We think it's likely 1 or 2. And as long as the signal is that the Fed is still going to cut rates, I think that is a positive as long as the economy stays resilient, which is our base call. What you don't want to see is an easing cycle that happens more aggressively because the economic growth is cooling much quicker than our expectations today. I
feel that we're living in a touch of Groundhog Day, but every day we talk about will the Fed cut and how much concentration do you want to technology. So let's take the Julian Emmanuel thesis this morning. He's calling 6,000. He is talking about an AI moment, and that is going to accelerate further. So let's just contextualize what he's saying. SPOs were up 1.6% last week. Tech component was up 6.4%. But here's what he reflects back on technology. The forward earnings are 30.4. Now, if you reflect back to the year 2000, the forward earnings were at 55.5. So on a comparative basis, there's still a long way to go. I would put it to you, it's a different basket of tech. But when you look at it from the purest earnings point of view, that does not say that we are at stretch levels. How do you respond to that?
Yeah, well, we're overweight tech. We've been overweight tech all year long. And the main thing with tech is tech tends to outperform when the earnings momentum for the sector is stronger than the overall market. That's still the case. And some of the big moves that we saw last week, we had 4 big cap stocks all move double digits. That tells you that not all the good news is priced in. So I think that's fair. My only caveat is I don't know that one of the biggest bubbles of history is the best comparison to say how much longer we have to go, because then you're betting on a bubble. But there are some things I'll just point out. If you look back in 2000, into that peak, the 3 years into that peak, the market or the S&P technology sector was up well over 300%. We're up about 70% today. So it's not the same. But again, the only caveat is you want to use that as the main comparison when that was a bubble. So that's what you'd be betting on. I think tech overall AI is somewhat, as far as the productivity gains, is somewhat somewhat early stage. I think what you're going to start to see is after these hyperscalers, you'll start to see on the software side, basically starting to accrue there, but it's going to be more marginal, meaning they're going to be able to raise their prices and add that as an add-on to some of their products for 3 or 4% gains per year. So it's going to be a big gain overall, but it's going to be marginal as far as, it's going to take time, and it's going to be kind of a step up each year is the way we look at it outside of the hyperscalers.
So beyond the hyperscalers, then, many people come on the show and they say they want picks and shovels. They want exposure to that. Is it a purely American picks and shovels conversation, or should we now be talking about a more global lean rather than all in on the hegemony of the U.S. tech supremacy?
Yeah, it's a good question. I mean, we've been Team USA for several years, and we are still Team USA. We think most of the best innovation is still in the USA. So if you're playing the AI thing, we still think it's the best place within the US. And you also think about it when you think about more index levels. The US has a lot more tech than, say, developed international markets, which typically outperform when the banks, some of the more cyclical areas are outperforming. And there's a lot of questions around Chinese tech and are their motivation around profit, probably less so than US. So I would say we would still stick, if you're looking for AI, I think that the US is the best place to be.
How did you and the team talk about the French shakedown last week? I mean, it really was the tail that wagged the global risk dog, didn't it? Bond yields lower, equities had a drive-by in France. There was a real moment of existential angst, and I was in Brazil, so I mean, I was tracking it from there, and it was really quite a gripping part of the conversation. How did you and the team talk about it?
Well, coming into this year, one of the things we talked a lot about is that we have more than 40 elections around the globe. So a lot of the focus, especially in the U.S., is around the U.S. elections and that uncertainty, but this just kind of reflects that there's global uncertainty. I still think on a relative basis, the U.S. is somewhat more stable. What's notable, going back to the equity markets, the MSCI EAFE index, right, the proxy for international developed markets, just made an all-time relative price low to the U.S. So in our perspective, that's still a negative. We've been, again, as I mentioned, Team USA. We have a big overweight to the U.S. We're still there. Maybe things are getting a bit extended on a short-term basis, but on a relative basis, for all the chaos we have in the U.S., I think we have actually somewhat more stability because of the institutions beyond just the presidency.
Look, there's no doubt about it. When you look at the funds flow, what is it? $30 billion of money flew into equity markets. 94% of that, according to Berenberg, was into the USA. So you don't see any sign of exhaustion. What about the rally in the bond yields? Was that driven predominantly, well, our last guest said, look, that is all about the data. That is all about the disinflation narrative. Or do you think a little bit of toxic politics from Europe pushed those yields lower as well?
Yeah, well, I think the move down from 470 to the current levels, I think a lot of that was a combination of cooler inflation numbers, right? We had the CPI number, the PPI number that was somewhat cooler. But I think the last move down was more of what's happening geopolitically. And we also had those initial jobs claims, which we have to watch closely, bumped up to above 240,000. So I think it's a mix overall. I think this level around 420 is an important one to watch. We're seeing a little bit of a bounce this morning. But in our strategies, when we were closer to 460, we went a little bit longer duration. I still think there's a decent hedge to have because of all this kind of geopolitical uncertainty and some of the cross currents. As we move past Memorial Day, we're seeing that the geopolitical risk, which were kind of quiet in the first half of this year, now come into focus.
Well, it certainly wasn't expected to come from the French quarter. Sure, it wasn't. Keith, thank you so much. There you go. Lessons of the European debt crisis. Dust off your books and have a look at your Franco-German spread. There you go. We'll be battered and bruised, Keith, before it's all said and done. That's Keith Lerner of Truist on the markets this morning. Coming up, those protests in France, as I said, erupt over the weekend as President Macron calls the election. More from Europe in just a moment. Context matters on Bloomberg. Turmoil in France over the weekend following the calling of an election. For more, let's bring in Oliver Crook. Oliver, we had the theatre of the G7. We had protests against Marine Le Pen on the streets of France. Nowhere near what we saw in terms of protesting against her father decades ago. How palpable is political instability in Europe? Good morning.
I think it's extremely palpable, and it's mostly demonstrated at Manus, as you say, by the protests that are going on in France. Of course, Macron was at the G7, where I was also attending, and I went to some of the scrums, that had little journalist gatherings after sort of main events. And all the journalists that were around Macron, they didn't ask really very much at all about his view on global politics, on the G7, on Ukraine, all that. The focus was squarely at home and in France, where he has basically now thrown the complete spanner into the work. You have to understand the sort of degree to which this sort of upheaval in sort of the traditional political orthodoxies in France, where he came in, was not affiliated with any of the main parties. There were these columns of the center right and the center left. Macron blew that all up when he got elected. And now when he is intensely unpopular, he has left a huge political void in the background, one that has been filled by the National Rally, by Le Pen's party, a party that, Manus, as you say, has spent literally decades trying to get to this point where it's seen as a sort of potentially legitimate and viable option in France, and now looking like it will sweep maybe a third of the vote in the legislative elections. This is really, truly unprecedented in France. And all these little sort of coalitions of the Republicans on the right, sort of, a little bit of chaos there, and these sort of wide coalitions on the left, they're pretty flimsy, Manus. So for the market, this is an intensely difficult thing to price.
It's interesting. Le Pen herself comes out and says, I'm respectful of institutions. I'm not calling for institutional chaos. Financial markets don't really understand the National Rally's project. And therein lies the point as to why French bond yields spiked. The spread to Germany, which is the benchmark, also exploded. And if you look at what S&P are assuming, they're looking at a deficit ratio of 112%. By the way, there is a roadmap for what's happening in France. It was Northern Ireland, of course, the re-edification of Sinn Féin and the accession to power there. let's talk about the relationships. You say nobody really was asking Macron about global questions, but there are global issues. This morning, breaking news that China are certainly assessing the situation on pork imports. Again, another layer of complexity post Xi Jinping sitting down with the leadership of Europe just a number of weeks ago.
Completely, Manus. And this is all the backdrop, whether it's the trade war, this instability in France, as today all of the European leaders are meeting to try to set out what the government looks like for the EU for the next 5 years, right? That is happening this evening in Brussels, where they're going to try to appoint all the commissioners and say who's going to be ahead of the commission for the next 5 years. And this is sort of the background. These are the global issues that they're dealing with. I mean, the pork one just alone, again, it hits a certain fragment of trade. It affects certain different countries within Europe differently, but it's not really about the pork, is it, Manus? It's about the tenor of what we're going in. Are we walking towards a sort of trade war? This is the big question for European leaders. And let's not forget, Manus, it's all very inflationary.
It is all very inflationary. Oliver, well done. Thank you very much. Setting the tone from Europe. Oliver Crook in Berlin. In corporate news, we've got UBS planning to give investors in Credit Suisse funds linked to the collapse of Greensill Capital. Remember that? In 2021, a significant proportion of their money back. Jeff Black is with me. I read the proportion that investors are going to get back, and I'm thinking, oh, this is interesting. I'm going to get a whacking chunk back in a disastrous investment. What's the number and why?
It's 90%. And for anybody that invested in these funds, which, as you will remember, of course, collapsed when Lex Greensill's business, lending to companies that maybe didn't have the revenue to cover the loans, went bust in 2021. If that's going to take an awfully long time, possibly another 3-4 years to resolve those claims. So UBS is trying to cut a clean line underneath the affair and give investors a reasonably good deal. And that's what they're doing, and they're managing a big reputational risk for them in the process.
Look, this is very reflective of the style of Armati, which is take the issue, deal with it, draw a line under it, either pay up and look large when it comes to regulation, pay up on the penalty. We saw it in a number of cases over his tenure when he was there before. They have taken a provision for this, so this is very much trying to close down issues and move along, isn't it?
Yes, although he can't completely close it down. The first issue is, of course, that provision, which is going to make a 900 million dent in second quarter profits. So that's one thing. The workout of the rest of the several billion worth of in those funds will take years. There's lots of legal claims against it. It will still continue to bump along in the background. It might not be such a financial risk for investors anymore, but it's still a risk for UBS. But yes, it's definitely a Armati style to try to make things go away in a sort of as decisive a manner as possible.
OK, Jeff, thank you so much. That is Jeff Black, UBS trading, as you can see, over the past year, up 47%. It is all about the dividend, the buyback, and the narrative there, of course, the battle royal on capital requirements is perhaps the issue hanging over the background for management. Let's pivot to China. We've got the property slowdown there. No signs of it letting up. The latest data, to say the least, is disappointing, leading to calls to pump more cash into the economy. This comes as the PBOC kept rates unchanged for the 10th straight month. Rebecca Chung-Wilkins has the key takeaways. Rebecca, we caught up a little bit earlier. I mean, as you reflect on this, would cutting rates really be the solution to a huge overhang and surplus, which has taken, you know, quite a significant period of time to build up?
Yes, I mean, I think the short answer is probably not, although there has been this debate that, of course, you know, PBOC, Chinese government should step in and do more. But the real sort of problem is trying to revive demand in the property sector itself, to try and put a floor under those prices so they stop falling. We did see in May those prices getting worse again. The absolute numbers look relatively small, but when you understand them in the scale of history, so existing home prices fell by 1%, the most since they started started collecting that data in this current form since 2011. And so the worry is that we are still not seeing a turnaround in the property sector, despite this 350 billion yuan plan to try and mop up some of that unsold housing, with governments, local SOEs stepping in to buy more properties. But it's really that plan that will be centrally in focus here, whether or not this affordable housing plan will be enough, whether it can be transmitted fast enough through the system to start turning around things.
Well, of course, that's going to take confidence, isn't it? You know, a great swathe of the Chinese middle classes had vested their future, their retirement, their wealth management in building property, in buying into the property narrative. I started by asking, was the PBOC cutting rates going to be a solution or a cure-all for the property sector? As you said, no. But then, is that much more about holding the line on the currency front for the PBOC rather than the domestic housing situation?
Yeah, absolutely. And I think for the PBOC, there is this sort of dual concern here. They're also looking at the Federal Reserve sending that message higher for longer, which is going to likely pressure the yuan. And so, you know, the PBOC is concerned about trying to resist anything that will add further pressure to the yuan, whilst also likely not really substantively changing things for the property sector. So quite a careful balance, but yeah, of course, fundamentally sort of quite a moderate response.
Okay. Rebecca, thank you so much. Rebecca Chung-Wilkins there with the very latest from China on the data. Quick snapshot of what's going on across your assets this Monday morning. There just seems to be a sort of a steadying in these equity markets, flat on the S&P 500, 5,500. You've got some massive call-outs from Julian Emmanuel at Evercore calling for 6,000 on the AI revolution is in the early innings, so that's 500 points higher than here. Citigroup upgrades the US to overweight, substantially higher growth tilt relative to Europe. The dollar is flat at the moment, and 10-year yields trade at 4.23. Again, both our guests this morning talk about the disinflation narrative. Neil Kashkari talks about being one and done from the Fed. So 4.23 is where we are. You've got a 20-year auction coming down the pike a little bit later this week. So that will test the longer end. $13 billion of 20-year paper. Coming up, a big week for central bank decisions. I'll run you through the slate in just a moment from a beautiful, hot New York. Good morning. Your Monday Bloomberg Brief. I'm Manus Cranny in New York. Here's how your week looks. More Fed speak coming this afternoon. Williams, Harker and Cook all hit the tape. U.S. markets will close then on Wednesday for Juneteenth holiday, and a marathon of central bank decisions coming from the UK, Switzerland, Norway, Indonesia and China. One or two micro movers for you. Keep an eye on Broadcom again, building on its strength from last week, up over 3%. They're planning a 10-for-1 stock split. AI added $3 billion in sales, the CEO tells us last week. And then, of course, you've got the Julian Emmanuel, the evangelization of AI, targeting 6,000 on the S&P 500 and the AI revolution by the end of the year. NVIDIA up 0.6%. No day is ever set without a price check on NVIDIA. Good morning. Bloomberg Brief closes. Surveillance raises from New York. This is Bloomberg.